Viewers at home, you are welcome to my presentation on consolidated statement of cash flows. Consolidated statement of cash flows or group statement of cash flows. Please, if this is the first time of you're coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be able to receive a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. Please, before proceeding to group statement of cash flows, I will advise you try to watch my presentation on single company statement of cash flows. So, now, in addition to my presentation on single company statement of cash flows, these are the features in the group financial statement that distinguish it from the single company financial statement. Number one, we have the goodwill. Goodwill. Remember, goodwill is the essence of consideration transfer over the fair value of net asset. And the format I gave you, I said goodwill, we have consideration transfer plus the fair value of NCI or plus NCI at the date of acquisition less fair value of net asset at the date of acquisition. Aside goodwill, we also have investment in associate. That is where there is an associate. Then we have investment in associate. Investment in associate will be found in the consolidated statement of financial position, while share of associate profit will be found in the consolidated statement of profit or loss. Then in addition to this, then you will have not controlling interest. Not controlling interest. Not controlling interest will be found in both the consolidated statement of financial position and consolidated statement of profit or loss. Investment in associates will be used to ascertain the amount of dividend received from the associate. It will be used to ascertain the amount of dividend received from the associate. While non-controlling interest will be used to ascertain the amount of dividend paid to non-controlling interest. Dividend paid to non-controlling interest. I've told you that the minimum requirement for the preparation of statement of cash flows are 1. 2 statements of financial position. 2. 1 statement of profit or loss and other comprehensive income. 3. Notes to the financial statements. Those are the minimum requirements. This presentation, I'm going to consider the treatment of subsidiary acquired during the year and the disposal of subsidiary in the consolidated statement of financial position and consolidated statement of cash flows. The part 1 of my group cash flows, I've examined the consolidated statement of cash flows involving subsidiary acquired during the year. While part 2, I examined the consolidated statement of cash flows involving the disposal of subsidiary during the year. Then this part 3, I'm going to consider questions. I'm going to solve comprehensive examination questions that will involve both the acquisition of subsidiary during the year and the disposal of the subsidiary during the year. So before I proceed to solving questions, I am going to explain some of these things just to recap our previous discussion on statement of cash flows. I want to recap. Number 1, I've given you the following steps for preparing the consolidated statement of cash flows. The first step is to 1. Calculate. Remember those features. The number 1 feature is goodwill. Calculate the goodwill of the subsidiary acquired. So before we consider the movement in goodwill, then you calculate the goodwill of the subsidiary acquired. That is the first step. Step 2, where this is for the case of subsidiary acquired during the year, but where there is a disposal of subsidiary during the year, calculate the goodwill of the subsidiary disposed at the date of the disposal. So calculate the goodwill of subsidiary disposed. Remember, the goodwill is consideration transfer less fair value of net asset acquired, or the consideration transfer plus NCI less fair value of net assets at the date of acquisition. Please take note of that. Now, the third step is to determine the movement. Determine the movement in goodwill. Determine the movement. Remember, I've told you, when determining the movement, that you compare the opening balance and the closing balance, then you look at those other items that will affect those transactions. So other items, maybe those ones that will lead to an increase in respect of that transaction or a decrease. So you consider that affect that particular transaction. That is what I mean by the movement in respect of goodwill. Now, we want to consider how to determine the movement in goodwill. The movement in goodwill will be used to ascertain or to determine whether goodwill has been impaired or not. We want to determine whether goodwill has been impaired. So movement in goodwill. Remember, I've told you that there is always two statements of financial position. You may be given 2021 and 2020. So the one in 2020 is closing, while the one in 2021 is the closing, while 2020 is the opening. Always start with the opening balance in any of your workings. So we have opening balance, the opening balance of goodwill, opening balance of goodwill. Then where subsidiary is acquired, then you have goodwill of subsidiary acquired. You add it. You will have determined the goodwill of the subsidiary acquired during the year in usual way. Consideration transfer plus the fair value of plus NCI minus fair value of net assets at the date of acquisition. So you add the one of the subsidiary acquired, anything that relates to the subsidiary. When you are dealing with the movement in respect of an item, so the one of the subsidiary transactions relating to the subsidiary acquired, you are going to add it. While the one relating to the subsidiary disposed, you subtract. Anytime you are dealing with movement in respect to anything. So goodwill of the subsidiary disposed. I've told you that of the subsidiary disposed, you are going to less it because you want to recognize that since that subsidiary has been sold. So then after this, you have this as a total. You now compare this with the closing balance. Closing balance, that is closing balance of goodwill. Closing balance. The closing balance, remember, it will be found in the closing statement of financial position. When you subtract that, then you have, if there is impairment, then this will exceed this. So you have impairment of goodwill. So that is the movement in goodwill. Then the second features in the consolidated financial statement, which I have mentioned that distinguish it from that of a single company, is the investment in associate. I've told you that the investment in associate will be used to determine the share of associate profit. Now let's look at the movement in investment in associate. After that, this will be used to determine the investor share of the associate profit. Always start with the opening balance as usual. Opening balance, that is investment in associate. Then after the opening balance, then you have the share of the associate profit. Remember, I've told you that the investor share of associate profit will be found in the consolidated statement of profit or loss. Investor share of the profit or loss. If it is loss, you subtract of associate. If it is profit, you add. If it is loss, you subtract. Then you may have the other comprehensive income of associates, if any. You have other comprehensive income of the associate. Other comprehensive income of the associate, if any, you add. And even this loss, you subtract. Then after this, you now have the closing balance. That is investment in associate. The investment in associate, remember, both opening and closing balance will be found in this consolidated statement of financial position. The opening balance will be found in the opening statement of financial position, while the closing balance will be found in the closing statement of financial position. This will represent the amount of dividend received from associate. Dividend received from associate. That is the movement in investment in associate. Then the third feature I made mention of that make the group financial statement different from the financial statement of that single company or single entity is the non-controlling interest. Non-controlling interest. Non-movement, let's have the movement in non-controlling interest. Remember, non-controlling interest is that part of the equity interest of the subsidiary. The part of the equity interest of the subsidiary that is attributable to the parties outside the group. So the movement in non-controlling interest, remember, we always start with what? Opening balance. Opening balance of non-controlling interest, which will be found in the opening statement of financial position. Opening balance will be found in the opening statement of financial position. Then after opening balance, then you have NCI share of total comprehensive income. NCI share of total comprehensive income. There you have that. Yeah. Then you also, if there is an acquisition of subsidiary, you have NCI of the subsidiary acquired. You add it. Then if there is a disposal, you have NCI of the subsidiary disposed. I've told you that of the subsidiary disposed you have to subtract whenever you are dealing with the movement in anything. So then you now have the closing balance. Closing balance, that is in respect of the non-controlling interest. After all this adjustment, you have the dividend paid to NCI. The balance will be the amount of dividend paid to NCI. In the group or in the consolidated financial statements, there are usually two dividends that will be paid by the group. The first one is the dividend paid to the owner, that is to the shareholders, the owners of the parent, and the dividend paid to NCI. Dividend paid to the owners of the parent, and that will be calculated. The dividend paid to NCI will be calculated from the movement in NCI, while dividend paid to the owners of the parent will be calculated from the movement in the retained earnings. Now let's have the movement in our retained earnings. Now, dividend and movement in retained earnings. Movement in retained earnings. The retained earnings will be, you start with the opening balance of the retained earnings. Opening balance, that is that of retained earnings or retained profit. Then we now have parent share of profit for the year. Parent share of the profit for the year. Then we also have the closing balance of retained earnings. After this, you have the dividend paid to the owners of the parent. So this is the format for ascertaining the dividend paid to the owners of the parent company or to the shareholders of the parent company. And that is the format. Then, in addition to these items, where there is an acquisition of the subsidiary, where there is an acquisition of subsidiary, you will need to determine the net cash paid to acquire subsidiary. Net cash paid to acquire the subsidiary. Net cash paid. Now, you now have cash. We now have purchase consideration. Purchase consideration, the one you use in calculating goodwill. Purchase consideration. It is the cash element of that purchase consideration that will be considered. Cash element. Cash element of the purchase consideration that will be considered. Then, it's not ideal for the investor to acquire a subsidiary and also acquire the cash of the subsidiary when cash will be used in the payment, when cash will be paid to the shareholders of the subsidiary. So where cash is included in the net asset of the subsidiary acquired, you are going to subtract that cash. You subtract the cash of the subsidiary acquired. And if it is bank, also you have the bank of the subsidiary acquired. But where you acquired an overdraft is a liability. You are going to add it. Add bank overdraft of the subsidiary acquired. You add. Then the net difference will be the net cash paid to acquire subsidiary, which will be reported as investing activities in our group statement of cash flows. Then, but where there is a disposal of subsidiary, then you will need to calculate the net cash received. In terms of acquisition of subsidiary, we call it net cash paid. But in terms of disposal, you are going to receive cash. So net cash received, that is disposal of subsidiary. So you will calculate the net cash received. Net cash received from the disposal of the subsidiary. And this net cash received, you have the proceed, the amount at which that subsidiary was sold. That is the sales proceed. Then it is not ideal for you to sell cash. If you sell cash, you are going to remove it. That means the amount you receive, if cash is included in what you sell, the amount you actually receive is not up to that. So you less cash of the subsidiary disposed. So you less it, and if it is bank of the subsidiary disposed. And if there is an overdraft, you add the bank overdraft of the subsidiary disposed. Bank overdraft of the subsidiary disposed. You add it. Now get the net cash received from disposal of that subsidiary. So these are the adjustments we are going to consider here. But before I solve question as work example, I want to give you the pro format of statement of cash flows involving the acquisition and the disposal of the subsidiary. Now let's have the pro format. Can have X, Y, Z group. Consolidated statement of cash flows for the year ended December 31st, 22X. The first heading is operating activities. Operating activities. In your operating activities, you are going to start with the profit before tax as usual. I believe you are familiar with this if you have watched my presentation on single component statement of cash flows. So you have profit before tax, profit before tax. Then we have adjustment for you may have non-cash items such as depreciation, non-cash items such as depreciation, then loss from disposal of non-current assets. Non-current assets. You add the loss, and if it is profit, you have profit from disposal of non-current asset. You subtract the profit, and when you have the share of associate profit, share of associate profit. If it is profit, you subtract, and if it is loss, you add. If it is profit, you subtract, and loss or losses should be added. Then if you have investment income should be subtracted, if any. Investment income. Then if you have gain on disposal of subsidiary, gain on disposal of subsidiary, you subtract gain, and if it is loss on disposal of subsidiary, you add. Then the impairment of goodwill which you have obtained. Impairment which you have obtained from the calculation of goodwill. When you check the movement in goodwill, that impairment, you add it. So we have the net cash flows from operating activities before changes in working capital. You now deal with changes in working capital, which include your working capital. I told you their current assets and current liabilities, where you are going to have increase, so decrease in inventories, meaning that if there is an increase in inventories, you subtract, while decrease should be added. Increase stroke decrease in receivables, you subtract increase and you less decrease. You subtract increase and you add decrease. Then increase stroke decrease in accruals. Let me say increase stroke decrease in payables. Increase stroke decrease in payables. That means decrease is what you are going to subtract, while increase should be added because it is a liability. Increase stroke decrease in accruals. Decrease is what you are going to subtract. So same is after that, you have net operating cash flows. after changing working capital. At this juncture, if you have interest paid, and taxes paid, if you have watched my previous presentation, I have explained how to calculate the interest paid and taxes paid, and I've given you comprehensive format on my single company statement of cash flows. So interest paid and the taxes paid. After this, you have net cash flows. Net cash flows from operating activities. After operating activities, then you have investing activities. Investing activities. Under investing activities, you have purchase of non-current assets, payment for purchase of non-current assets. The amount you paid is an outflows. Then we have, when you sell non-current assets, you have the proceeds from disposal of non-current assets. Proceeds from disposal of non-current assets. Non-current asset, that is, proceed is an inflows. Then net cash paid to acquire subsidiary. Net cash paid to acquire subsidiary, that is outflows. And if there is a disposal of subsidiary, you have net cash received from disposal of subsidiary. Net cash received from disposal of subsidiary, that is an inflows. Then when you acquire an associate, you have cash paid to acquire an associate, where you acquire an associate during the year. Then you may have dividend received from associate. I'll give you the format for calculating that. Dividend received from associate. This cash paid is an outflows. Dividend received from associate. Then you will have interest received as well. Interest received. So you now have net cash flows from investing activities. Net cash flows from investing activities. After investing activity, the third heading is financing activities. Remember, I've told you that investing activities involve changes in non-current assets and investment, while financing activity involves changes in equity and borrowings. So, you share the movement in equity, then you may have proceeds from issue of shares. Proceeds from issue of shares. Then you may also have issue of loan notes or debenture. Then we can have repayment of loan notes, cash repayment of loan notes, That is an outflows. Then you can have lease liability payment. You might have dividend paid by the parent. Dividend paid by parent. Then you can also have dividend paid to NCI. I've given you the format for this. Then you may now have net cash flows from financing activities. Net cash flows from financing activities. Net cash flows from financing activity. Then you now add what you have for operating activities, net cash flows from operating activities, plus net cash flows from investing activities, then plus net cash flows from financing activity. Then the sum of the three will be the net cash change. After the net cash change, now add cash or cash equivalent at the beginning of the period. Then after adding that, then you get the cash or cash equivalent at the end of the period. So I want to take question as work example. This is a comprehensive question involving the acquisition and the disposal of subsidiary during the year. So, example, we have below are the consolidated financial statements. Below are the consolidated financial statements of Pearl Group. For the year ended 30th of September 20x2. Year ended 30th September 20x2. You have non-current assets. The non-current assets, we are given 20x1 and 20x2. We have goodwill. We have 1930, and 1,850. We have property, plant and equipment, 2,545 and 1,625. Please, you may pause your video so that you'll be able to copy out the question for better understanding. Just pause it. So pause your YouTube video. Then whenever you want to copy out the question, and copy out the question so that you'll be able to understand the explanation better. Investment in associate, 620 and 540. Total of non-current assets, 5095 and 4015. Then we have current assets. Inventories, 470 and 435. Trade receivables, 390 and 330. Cash and cash equivalents, 210 and 1,000 and 140. Total assets, 6,165 and 4,920. Then we have equity and liabilities. Equity and liabilities. Then we have share capital, $1 shares, which is 1,500. Then retained earnings, 1,755 and 1,085. Then other reserves, 750 and 525. Total of then equity attributable to the owner is 4,005 and 3,110. Then we have non-controlling interest, 310 and 31020. Total equity is 4,315 and 3,430. This question is obtained from Kaplan ACCA SBR test, strategic business reporting test. Then we have non-current liabilities, which include loans 500 and 300, deferred tax 150 and 105. Then we have current liabilities, which comprises trade payables of 800 and 725, then tax payables of 400 and 365. Then we have total equity and liabilities of 6,165 and 4,920. Then we have then the statement of consolidated statement of profit or loss. We have consolidated statement of profit or loss and other comprehensive income for the year ended 30 September 20x2. We have revenue of 2090, operating expenses of 1,155, profit from operation of 935, gain on disposal of subsidiary 100. Then we have finance cost of 35, share of profit of associate of 115. Then we have profit before tax of 1,115. Then we have tax of 225. Then profit for the period is 890. Other comprehensive income, we have 200. Then we have total other comprehensive income from associate of 50. Then total comprehensive income is 1,140. Then profit for the year attributable to owners of the parent is 795, and non-controlling interest of 95, total 890. Then we also have total comprehensive income attributable to, then we have owners of the parent of 1,020, non-controlling interest of 120, total is 1,140. Then we also have consolidated statement of changes in equity. Consolidated statement of changes in equity. We have attributable to owners of parent, then attributable to NCI. Then we have equity brought forward 3,110 and 320. Total comprehensive income 1,020 and 120. Then acquisition of subsidiary 340, disposal of subsidiary 420, dividends 125 and 50. Equity carried forward 4,005 and 310. Then we have the additional information. Now, depreciation of 385,000 was charged during the year. Plant with a carrying amount of $250,000 was sold for $275,000. The gain on disposal was recognized in operating cost. Certain property were revalued during the year, resulting in a revaluation gain of $200,000 being recognized. That is note 1. Note 2. During the year, Pearl acquired 80% of the equity capital of GEM, paying cash consideration of $1.5 million. The NCI holding was measured at its fair value of $340,000 at the date of acquisition. The fair value of GEM's net asset at acquisition was made up as follows. We have the property, plant and equipment of 1,280. We have inventories of 150, trade receivables of 240, cash and cash equivalents of 80, trade payables of 220, and tax payables of 40. Total of the net asset at acquisition is given to be 1,490. Note 3. During the year, Pearl disposed of its 60% equity shareholding in Stone for cash proceeds of $850,000. The subsidiary had been acquired several years ago for cash consideration of $600,000. The NCI holding was measured at its fair value of $320,000 at acquisition, and the fair value of Stone's net asset were $730,000. Goodwill had not suffered any impairment at the date of disposal. Then we have the net assets of Stone were carried in the consolidated statement of financial position as follows. The first one is property, plant and equipment. Remember Stone is the subsidiary which was disposed during the period. Then inventories, property, plant and equipment is 725, inventories of 165, trade receivables of 120, cash and cash equivalents of 50, trade payables of 80. The net asset of the subsidiary disposed was given to be 980 required. Prepare the consolidated statement of cash flows for Pearl Group for the year ended 30 September 20x2. So you want to prepare the consolidated statement of cash flows for Pearl Group. So for the period as at 30 September 20x2. So now let's have the solution. We have solution. We have Pearl Group. Then consolidated statement of cash flows for the year ended 30th September 20x2. 20x2. So we have triple zeros attached to the dollar sign. So the first thing should be the operating activities. Operating activities. Remember, under indirect method, the first thing under operating activity to start with will be profit before tax. Profit before tax. You go back to the statement of profit or loss to find out the amount of profit before tax given. You have profit before tax. Profit before tax 1115. So our profit before tax is given to be 1115. 1115. Then we now have adjustment. Adjustment for, I've told you that those things to adjust will include non-cash items and those items to be treated net of operating activities. Those items to be treated net of operating activities will as well be adjusted. So the first thing I told you should always do, always check the statement of profit or loss from the beginning to where you have profit before tax, which you have selected. Those things you are going to adjust are those things that has a bearing on this profit before tax. That is those things that has affected our profit before tax are those things that will require adjustment. Anything that doesn't affect this profit before tax will not require any adjustment. Now, if you look at this, we have revenue is normal. It arises in normal activities. Operating expenses may arise in normal activities. Operating profit. Then we have gain on disposal of subsidiary. That is extraordinary. It is not the principal activities of the business. So that you will need to adjust the gain on disposal of the subsidiary, which is given to be $100. Then we also have finance cost of $35. Is not the normal activities of the business. So it arises in the process of sourcing for funds to finance the business. The share of profit of associate. This follows accrual-based principle. It follows the accrual-based principle. So it is not, it will require adjustment. So you don't need anything after the profit before tax. So we are going to adjust for these three things: gain on disposal of subsidiary, finance cost, and share of profit of associate. Now let's have them. So the first thing is gain on disposal of subsidiary. Gain on disposal of subsidiary, and that is 100. The gain has led to an increase in the profit before tax, so you are going to subtract that. Then we have finance cost. Finance costs are interest related items. Finance cost has led to the reduction in the profit before tax, so you add the 35. You are going to add that. Then share of profit of associate. Share of profit of associate. It has increased our profit before tax, so we are going to subtract that. So which is 115. So we subtract it since it has led to an increase in our profit before tax. After those are the items that you can identify on the face of the statement of profit or loss. The next thing, you go through the note to see if there are other items that will affect the profit before tax that will require adjustment. Number one, note 1. We have depreciation of 385,000 was charged during the year. Remember, depreciation will have been charged as an expenses. Of course, it will be charged as an operating expenses. That means it will have led to the reduction in the profit before tax. Remember, depreciation is not a cash flows, and our statement of cash flows is a cash flow. So depreciation is not a cash flow. So we are going to adjust the depreciation of 385,000. So let's have depreciation. Depreciation 385,000. 385. We are going to add depreciation since depreciation has led to the decrease in the profit before tax. So now let's read further. Plant with a carrying amount of 250,000 was sold for 275,000. This is the proceed. This is the carrying amount. There is a disposal of plant. Disposal of plant also follows the accrual based principle. So it's not a cash based principle. So that profit which have been recognized have to be recognized. The gain on disposal was recognized in operating cost. So since that gain has been recognized, now have gain on disposal of plant. Gain on disposal of plant. The proceed is given to be $275,000 and the carry amount is $250,000. Then that means you have the gain of $25. You are going to subtract that gain because gain will have led to an increase in our profit before tax. Now let's read further. So let's read further. Certain property were revalued during the year, resulting in a revaluation gain of 200,000 being recognized. In fact, this is a revaluation gain. It doesn't affect our profit before tax. So remember, revaluation gain will be treated as other comprehensive income. Since it doesn't affect the profit before tax, so there is no need of you adjusting it. in our profit before tax. Now, note 2. During the year, Pearl acquired 80% of the equity capital of GEM, paying cash consideration of 1.5 million. The NCI holding was measured at its fair value of 340,000 at the date of acquisition. The fair value of the GEM's net asset at acquisition was made up as follows. So now this is an acquisition of a subsidiary. This is an information about the acquisition of GEM. Since GEM was acquired, then you will need to ascertain the goodwill on acquisition of GEM. Now we want to determine the amount of goodwill on acquisition of GEM. Let's have acquisition. The consideration is 1.5 million and the NCI is 340,000. Now let's calculate goodwill on acquisition of GEM. Acquisition of GEM. Let's have the working here. Acquisition of GEM. So we have consideration transfer, consideration transferred, and that is given to be 1.5 million. The NCI, not controlling interest, which was measured at fair value, and you were given the fair value of NCI to be 340. When you add the 340 to 15, then you have 1,840. Then from this, you less the fair value of net assets at the date of acquisition. And how much is the fair value of net asset of GEM at the date of acquisition? You were told the fair value of GEM's net asset at acquisition was made up as follows. So this is the fair value, and the total is 1,490. Now you subtract the 1,490, then in order to obtain the goodwill, 1,490. If you subtract 1,490 from the 1,840, so 1,840 minus 1,490, then you have the goodwill to be 350. Then the goodwill will be 350 on acquisition of GEM, 350. Then that is note 2. Now note 3. During the year, Pearl disposed of its 60% equity shareholding in Stone for cash proceeds of 850,000. This is a disposal of subsidiary. Remember, I've told you that you have to calculate the goodwill of the subsidiary acquired and the goodwill of the subsidiary disposed before you can calculate the movement in goodwill. Now, let's calculate the goodwill of the subsidiary disposed. Now, goodwill of the subsidiary disposed. Remember, you will also need the consideration transfer. During the year, Pearl disposed of its 60% equity shareholdings in Stones for cash proceeds of 850,000. This is not the consideration transfer. This is the proceeds, the amount at which the subsidiary was disposed. The subsidiary had been acquired several years ago for cash consideration of 600,000. This is the consideration transferred that will be used to compute the goodwill. The NCI holding was measured at its fair value of 320,000. This is the fair value of NCI. That means to compute goodwill, you have the consideration transfer of 600,000 plus the NCI of 320,000. Then you'll be having 920,000 at acquisition. And the fair value of Stone net asset was 730,000. That is at acquisition. That means the fair value of net asset, where you have the 600 plus 320, that is 920. 920 minus 730. Then you have the goodwill of 190,000. Now let's have the goodwill on acquisition of GEM, of Stone. Acquisition of stone. Acquisition of stones. So we have the consideration transferred, and which is $600,000. We have the NCI on acquisition of stone, which was given to be $320,000. When you add it, you have $920. Then you now have fair value of net assets at the date of acquisition. The fair value of net asset of stone at the date of acquisition was given to be $730,000. When you subtract the $730,000 from the net asset at the date of acquisition, then you have the goodwill to be $190,000. That is the goodwill on acquisition of stone. Goodwill on acquisition of stone. Then we have obtained two goodwill now. The one on acquisition of stone, and that is $190,000, and goodwill on acquisition of gem, and that is $350,000. Then you can now have the movement in goodwill. Movement in goodwill. I've told you that the movement in goodwill will be used to ascertain the amount of goodwill which was impaired during the period. Now, let's have this to be working one. I mean, acquisition of gem, while acquisition of stone, let's have that to be working two. Acquisition of stone, working two. Then this is working three now. Movement in goodwill. Movement in goodwill. Remember, I've told you that in your movement, you always start with the opening balance. Opening balance. That is your opening balance of goodwill, which will be found in the opening statement of financial position. Now go back to your statement of financial position. Then how much is our opening balance of goodwill? The goodwill, remember, you are given 20x2 and 20x1. The one under 20x1 will be opening balance 1,850, while the closing balance is 1,930. So opening balance is 1,850. Opening balance 1,850. Then goodwill on acquisition of gem. Acquisition of gem. Then we have goodwill of 350,000. Goodwill of 350,000 on acquisition of gem. Then disposal of stone. Disposal of stone. Then we have the goodwill. Goodwill of stone. We got 190,000. You are going to subtract that because it is disposal. You do recognize it. Disposal of stone. We got 190,000. No, stone is the subsidiary which was disposed during the period. So we are going to subtract the goodwill of stone. Then, after all this adjustment, 1,850 plus 350 minus 190. Then you have 2010. 2010. Then the closing balance. The closing balance, that is the closing balance of goodwill in the closing statement of financial position, which was given to be 1,930. The 1,930 is lower than this. So when you subtract that minus 1,930, then you have the difference of 80. That 80 represents impairment loss or impairment of goodwill. So now you go back to your statement of cash flows Then you have impairment. Impairment, which is working 3, and we got 80. So now after those adjustments, 100, we have 100 minus 100. Then we have a finance cost of 35. Then we have share of associate profit of 115 minus 115. Then we have depreciation of 385 plus 385. We also have a gain on disposal of plant, which is 25 minus 25. Then we have a impairment of 80 plus 80. Then we have 260. Then 260. Then if you add the 260 to 1,115 plus 1,115, then you have 1,375. 1,375. That is net operating cash flows or net cash flows from operating activities before changes in working capital. Before changes in working capital. Then after this, the next thing you are going to deal with is the changes in working capital for the period. You have our changes in working capital. Remember, working capital are purely current assets and current liabilities. You are going to exclude those ones that are to be treated net of operating activities. You have your current assets. So, current asset, which include inventory, trade receivable, cash, and cash equivalent. This cash and cash equivalent will be excluded. So, because it's a cash equivalent, and that will be treated net of operating activities. Then, current liabilities as well. Trade payables will as well be considered. Then, tax payable will not be considered because tax will be treated separately. It will be treated net of operating activities. So, now let's have our working for now. Working for, which is changes in working capital. Changes in working capital. Changes in working capital. So our working capital, we have trade payables, trade payables, we have trade receivables, we have inventories, don't forget, I've told you that whenever you are dealing with movement in respect of anything, that you should always start with the opening balance. Opening balance. Remember, your opening balance will always be found in the opening statement of financial position. Now, how much is the opening balance of those assets? Remember, this is the opening entry, 20x1. This is opening entry. This is the closing. Inventories opening is 435, and trade receivables 330. Then under liability, current liabilities, you have trade payables there, 725. Now let's lift the opening balances. Opening balances. Inventories, we have 435. Trade receivables, you have 330, and trade payables we have 725. These are the opening balances. Then you check your acquisition. If any of those current assets were acquired during the year, Pearl acquired 80% of the equity capital of GEM, paying cash consideration of 1.5 million. The NCI holding was measured at its fair value of 340,000 at the date of acquisition. The fair value of GEM's net asset at acquisition was made up as follows. These are the net assets. So this net asset, it includes inventories. It also includes trade receivables. Then we also have trade payables. So I've told you that the one acquired, you have to add it. That means we are going to add these three items: 150, 240, and 220. So we have acquisition of GEM, acquisition of GEM. Inventory of GEM acquired is 150. Then receivables of GEM acquired is 240. And trade payables of GEM is 220. Now, after acquisition of GEM, we also have disposal of stone. You check the information about disposal. During the year, Pearl disposed of its 60% equity shareholders holding in stone for cash proceeds of 850,000. The subsidiary had been acquired several years ago for cash considerations of 600,000. The NCI holding was measured at its fair value of 320,000 at acquisition, and the fair value of Stone's net asset were 730,000. Goodwill had not suffered any impairment. At the date of disposal, you were told that the net assets of Stone were carried in the consolidated statement of financial position as follows: property, plant, and equipment. Then we have inventories. Notice is the inventory of the subsidiary disposed. Trade receivables and trade payables will be considered. Cash equivalent will be excluded. 165, 120, and 80 will be derecognized. So since it was disposed, then we are going to derecognize those assets. So we have disposal of stone. The inventories of stone is 165. Because it was disposed, you subtract. Thereof, trade receivables 120 and trade payables of 80. So now, after those adjustments, so you now have, now let's press our calculator. You have 420. 420. This plus this minus this, 420. Then 330 plus 240 minus 120. Then we have 450. Then 725 plus 220 minus 80. Then we have 865. 865. After that, you have closing balance. Closing balance. You check the closing entry. I've told you that your closing entry will be found in the closing statement of financial position. Now, let's check our closing entry. Inventory is 470. Trade receivable 390. Then trade payables of 800. So now closing balance or closing balances. So inventories of 470. Then trade receivables of 390. And the trade payables is 800. After this adjustment, you have the increase. Increase will be negative, stroke decrease. In 470 minus 420 minus 470 will be minus 50. So this is an increase because the closing balance exceeds this. This one is a decrease because 450 exceeds 390. 450 minus 390, then you have 60. Then 865 minus 800, then you have 65. This is also a decrease. So we now have, what do we incorporate? Our changes in working capital. Changes in working capital for the period. Now let's incorporate our changes in working capital. Changes in working capital. Number one is inventories. We said there is an increase in inventories, and the increase as calculated is 50. Remember, we are going to subtract increase in inventory minus 50. Then aside inventory, we have trade receivables, and in the case of trade receivable, we have a decrease in trade receivables. We are going to add the decrease because receivable is an asset. Then our payable, we have decrease in trade payables. This is liability. The decrease is 65. Decrease, that will be minus. It's a liability. 50 minus 50 plus 60 minus 50 plus 60 minus 65. Then we have minus 55. Minus 55. If you now subtract 55 from 1375, so if you subtract this 55 from 1375, then you have 1320. 1320. Then after that, you consider the interest paid. Interest paid. There is no accruals of interest. If there is accrual in it of interest, that will be found under current liabilities. We only have two items as current liability: trade payables and tax payables. If it is not found under current liability, then you might have it in the note to the financial statement. But since there is nothing as such, that means the entire finance cost, the whole of the interest was paid. That is why you did not have anything as accrual or accrued interest. So the finance cost of 35 will be paid. So since there is no accruals of interest, after interest we have the taxes paid. Changes in working capital, let me have that as working 4. This is working 4. Now our working 5. Now let's deal with taxes paid. We want to incorporate our taxes. Working 5. Taxes paid. So remember, you are starting with the opening balance. Opening balance, current year tax, current tax. The current tax under current liability in the statement of financial position, you have 360. Then we also have deferred tax under non-current liabilities of 105. That is, those two are opening balances. Current, you have 360. Then deferred tax of 105. Those are the two opening balances. Then the tax expense in our statement of profit or loss. Tax expense in the statement of profit or loss, and the amount of tax that was charged as an expense or expenses in the statement of profit or loss. We have the tax of 225. Tax of 225. That is the amount of tax that was expensed in the statement of profit or loss. 225. 225. Now go back to the information about the acquisition of subsidiary. If any tax was acquired, then tax acquired from subsidiary is 40. Acquisition of gem. Acquisition of gem. The tax acquired from gem is 40. So you add it because it's acquisition. Then you also check information about disposal. If there is disposal, if tax was disposed, but there is no tax in the disposal of gem, since no tax is included, so you consider the closing balance. The closing balance of tax, the closing balance, we have deferred tax of 150. Then we also have a current tax of 400. 400 plus 150, that will be 550. So closing balance. Closing balance. The current is 400. Then deferred tax, and the deferred tax is 150. So after this adjustment, you have tax paid. Taxes paid. Taxes paid. If you take your calculator, taxes paid 360 plus 105 plus 225 plus 40 minus 400 minus 150. Then you have 180. 180. That is the amount of taxes that was paid. 180. Now, you go back to your statement of cash flows. Then we have taxes paid. Taxes paid. That is working 5. And that is 180. Tax is a payment which was paid. So you subtract. So that is working 5. After taxes paid, so now let's subtract in order to get net cash flows from the operating activities. So net cash flows from the operating activities. So our net cash flows from operating activities after those adjustments will be 1105. 1105. That is net cash flows from operating activities. Net cash flows from operating activity. So we have 1105. After operating activities, the next heading will be investing activities. Investing activities. Remember, I told you that investing activities are activities that result in changes in non-current assets and investment. So I've told you that whenever you get to investing activities, you are going to deal with the movement in non-current assets. The movement in non-current assets. So that is the next thing to consider. Now, remember, you always start with the opening balance. So now, working 6, they have the movement. Working 6. They have movement in property, plant, and equipment. Movement in property, plant, and equipment. Don't forget, we always start with the opening balance. Opening balance of PPE. PPE. Our opening balance is given. Opening balance of PPE is 1625. 1625. 1625. That is the opening balance. Now, what are those information that will affect PPE in the question? We have depreciation, we have disposal, we have acquisition. So now, note 1, depreciation of 385,000 was charged during the year. Depreciation will lead to reduction of 385,000. Plant with a carrying amount of 250,000 was sold for 275,000. We also have carrying amount of plant disposed, 250,000. Let's deal with that. We have depreciation of 385,000. 385. Depreciation will lead to reduction. So that is why we are subtracting the 385,000. Disposal of plant. Disposal of plant. It is the carrying amount to consider. Carrying amount. Because even your opening and closing balances is at the carrying amount. So that is why the amount to consider must be the carrying amount, not the proceeds. Since it is disposal too, disposal will lead to reduction in PPE. Back to the question. So, the gain on disposal was recognized in operating costs. Certain property were revalued during the year, resulting in a revaluation gain of 200,000 being recognized. There is a revaluation of PPE of 200,000. Revaluation gain of 200,000 or revaluation surplus. Revaluation gain will lead to an increase in PPE, while the revaluation deficit will lead to the reduction in PPE. Now, that revaluation has been considered. Note 2, during the year, PL acquired 80%. This is acquisition of subsidiary. And PPE acquired from the subsidiary, that is from GEM, is 1,280. That will lead to increase since more PPE were acquired. Acquisition of GEM. So we have acquisition of gem, which is 1,280. Then on the subsidiary that was disposed as well, we have the PP that was disposed. Disposal, we have 725. Disposal of stone. Disposal of stone. Disposal of stone, which is 725. Disposal is minus. After this adjustment, now let's cast it. So we have opening balance 1625. Plus minus 385 minus 250 plus 200 plus 1,280 minus 725, and then we have 1745. 1745. That is the value. That is what the value of PP ought to have been. But if you look at the closing balance of PP, closing balance, the closing balance of PP is 2545. 2545. 2545. If you look at the closing balance, it exceeds this. Now 2545. There is a difference of 800. Since the closing balance exceeds this, that means more of the PP have been bought. There is purchase of PP, purchase of property, plant, and equipment, and this will be recognized as an investing activity, in the consolidated statement of cash flows. Purchase of PPE 800. So under investing activity, you are going to have the purchase of PPE. Now let's have that. Purchase of PPE, that is working 6. Working 6. When PPE is bought, more cash will be expended. More cash will be spent. So that is why we are going to subtract the 800,000. Now, remember, I've told you that investing activity are activities that result in changes in non-current assets and investment. Now, aside that, we still have one non-current asset. Non-current assets, we are still on non-current asset. We have dealt with PPE. Then we still have investment in associate. Investment in associate. Now let's consider that. Investment in associate. Investment in associate. That is working 7. Working 7. So let's have movement in investment in associate. Remember, I've told you that this investment in associate, I've told you that it will be used to ascertain the amount of dividend received from the associate. Now, you are starting with the opening balance as usual. Opening balance, that is of that investment. And then you are given the opening balance to be 540,000. 540,000. Now, if you go through the statement of profit or loss and other comprehensive income, you will see the amount of profit that an associate received share of associate profit. Now, how much is that? Share of profit of associate. Share of profit of associate is 115. We are going to add it since it is a profit. Then, if you look at other comprehensive income, you have other comprehensive income of associate, and that is given to be 50,000. So you are going to consider these two: the share of associate profit of 115, share of profit of associate of 115, and other comprehensive income of 50. Now, let's incorporate that. Share of profit of associate, and that is given to be 115. Then we also have other comprehensive income from associate. Other comprehensive income from associate. And that is given to be 50 in our statement of profit or loss under other comprehensive income. We have 50. Then we now have the closing balance. Closing balance. Our closing balance is given to be 620. As it is given, 620. After this adjustment, then you have dividend received from associate. So, after those adjustments, how much will be the dividend received from associate? Then you have 85. That is the amount of dividend received from associate. Then you include it as investing activities. Dividend received from associate. That is working 7. That is 85. This is a dividend received. So it will be an inflows. Now, no other items of non-current asset. Then remember, there was a disposal of a plant leading to, and you are given the proceed from disposal of plant, and that is given to be 275. Where you have the disposal, note 1. The disposal of plant at a proceed of 275,000. So, proceed from disposal of plant. Disposal of plant proceed. Disposal of plant. I mean the proceed from it, which is given to be 275. Now, after that, I've told you that whenever a subsidiary is acquired, you are bound to pay cash upon the acquisition of that subsidiary. Whenever subsidiary is acquired, you are bound to pay cash for the acquisition of that subsidiary. Now, let me have working 8. Now, working 8. net cash. Net cash. Or let me just put acquisition of gem. Acquisition of gem. We have the cash consideration. The consideration, cash consideration. The consideration you pay on acquisition of gem, that's that subsidiary. You paid 1.5 million. That is the amount that will be considered. 1.5 million. As at the time you acquired the subsidiary, did you pay out any, do you acquire cash from that subsidiary? So now you have cash and cash equivalent, which is 80, which was acquired. So I've told you that you are going to less that, because it's not ideal you acquire it and when you want to pay cash and you again acquire cash. So cash equivalent, which is 80. When you subtract 80 from 1.5, you'll be left with 1,420. That is the net cash you pay for the acquisition of the subsidiary. Net cash paid for the acquisition of the subsidiary. So now let me have it here. So acquisition of gem. Acquisition of gem. You pay 1,420. Let me also have disposal of stones. Acquisition of gem, that is working 8. Disposal of stone, let me have that to be working 9. Now, when you dispose of stone, how much was the cash you received upon the disposal of stone? So that is what we want to determine now. Working 9. Disposal of stones. Now, how much was the proceed? When you dispose of stone, how much did you receive? The amount you receive upon the disposal is called the proceed. During the year, per disposal of its 60% equity in shareholding in stone, 60% equity shareholding in stone for cash proceed of 850,000. The proceed is 850,000. We have proceed of 850,000. As at the time you dispose of stone, did you dispose of any cash with it? You check the net asset of stone at the disposal date. Then you have cash and cash equivalent of 50. So you are going to remove that from the net asset of stone. So we have cash and cash equivalent. Cash and cash equivalent of 50. If you remove 50 from 850, then you'll be left with 800. That is the proceeds from disposal of stone. There you have 800. 800. That is proceed. Now, you cast your investing activities. you have minus 800 plus 85 plus 275, then minus 1420 plus 800. Then you have 1060 minus 1060, which is our net cash flows from investing activities. Net cash flows from investing activities, which is 1060. After investing activities, then you have financing activities. I've told you that financing activities, I said they are activities that result in changes in equity and borrowings. They result in changes in equity and borrowings. So now, I've told you that now we have, if you look at movement in equity, statement of changes in equity, consolidated statement of changes in equity. Then you have equity brought forward, total comprehensive income, acquisition of subsidiary, disposal of subsidiary. Then you have dividend paid. Dividend paid. The one paid to owners or parent is 125. The one paid to NCI is given to be 50. Now we have dividend paid. Dividend paid to owners of the parent. That is from statement of changes in equity. Statement of changes in equity. So this figure is obtained from the statement of changes in equity, and which is 125. 125. So now let's include that. 125, that is the dividend paid. Then we also have dividend paid to NCI. Paid to NCI. Remember, where this is not given, we also obtain this from statement of changes in equity, and that is 50. If this is not given, your dividend paid to the owners of the parent will have been the opening balance of the retained earnings, and the opening balance of the retained earnings in the statement of financial position is 1085 plus the parent shares of the profit for the year, which is 795. 1085 plus 795, then you have 1880. Then the closing balance of retained earnings is 1755. You now have minus 1755, then you have 125, which agrees with what we have in our statement of changes in equity, 125. So you also follow the same format for dividend paid to NCI in order to calculate that where it is not given. Now, what are other items of equity we can find in the question? Remember, I've told you that equity comprises that whenever you get to equity, you want to check movement in equity and the borrowings. The movement in equity, this is constant, so no issue of shares. That is why it is the same 115. Retained earnings, that will have been used to obtain dividend paid, and we have been given. Other reserves, you don't need that. The difference will represent the amount of revaluation. Then the NCI, you have been given dividend paid to NCI, so you may not need that. Then loans. We have loans of 500 and 300. 300 in the opening, 500 in the closing. That means they have issued additional loans of 200. Issue of loans, loan notes. Issue of loans. The closing is 500,000, while the opening is 300,000. In the statement of financial position, you have 200. So now let's cast it. Then we have minus 125 minus 50 plus 200. Then we have 25. We have 25. That is net cash flows from financing activities. Net cash flows from financing activities. And that is 25. Then you cast everything. Your operating activities. You have net cash flows from operating activity 1105. Then investing activities, you have minus 1060. Investing activities minus 1060. Then financing activities, you have plus 25. Then you have 70 as a net cash change. Net cash change is 70. After that, you have cash and cash equivalent at the beginning of the period. Cash and cash equivalent at the beginning of the period. If you check your opening statement of financial position, you have cash under current assets. You have cash and cash equivalent of 140. So we have cash and cash equivalent at the beginning, and that is 140. If you add the 140 to 70, you have 210. And if you check your closing statement of financial position under current asset, you have 210 there. So you see the same 210. That will be the cash stroke cash equivalent at the end of the period. Please, all these lectures, in order to aid your searching, all my lectures have been organized in a playlist. You can just search Ezikan Academy or Ezikan on your YouTube app. Then it will take you to my YouTube page. Then click on my page icon. Then you will see playlist. Then if you see playlist, then click on that playlist and look for the SBR playlist that contains LBR or corporate reporting. Then you will see this video there and some relevant videos on corporate reporting and every other videos by me. Please don't forget to subscribe if you have not subscribed in the past. Thanks.